Europe's economic reality? Have the great powers given up? Let's be honest. When you think economic powerhouse, you probably still picture Germany's factories, France's prestige, and Italy's creativity. But quietly, almost in slow motion, something big is changing. Today, I want to walk you through what's really happening under the surface in these three countries, not in a doom and gloom way, but in a clear, investor-focused way so you can judge for yourself whether we're looking at a temporary slowdown or the long fade of old economic giants. If you like breaking down big global shifts with a calm, analytical lens, without the hype, but with all the context, hit subscribe now and stay with me. These are exactly the kinds of trends that shape portfolios over the next decade, not just the next quarter. Let's start with Germany. For years, the straight-A student of Europe. Export machine, budget discipline, industrial excellence. If Europe had a balance sheet, Germany was the crown jewel. But right now, that machine is misfiring. Germany has roughly 750,000 unfilled jobs. That's not just a skills gap headline. That's a structural constraint on growth. Companies literally cannot find enough people to run the factories, manage the supply chains, or keep the engineering labs going. The core issue? Demographics. Germany is aging fast. Birth rates have been low for decades, and now the bill is coming due. A large wave of skilled workers is retiring, while fewer young people are entering the labor force. Imagine trying to run a global manufacturing empire while your workforce pipeline is slowly drying up. That's basically what's happening. And replacing that human capital isn't something you can fix in a year or two with a stimulus package. Then you have the middle stand. Those mid-sized, often family-owned firms that quietly dominated niche markets for decades. Many of the founders are in their 60s or 70s. The next generation doesn't always want to run a precision tools company in a small town, when they could be building apps in Berlin, London, or Silicon Valley. So you've got succession risks, aging owners, and the potential loss of decades of know-how. From an investor's perspective, that's not just a story about one family business. It's a story about the long-term erosion of an entire industrial ecosystem. Layer on top the energy shock after Russia's invasion of Ukraine. Germany built its industrial model on reliable, cheap Russian gas. That's gone. Now energy is more expensive, margins are tighter, and suddenly it's no longer obvious that producing in Germany is the rational economic choice. We're already seeing some companies shift production abroad to cheaper, more flexible environments. So the question becomes, can Germany reinvent its model fast enough through immigration, automation, and innovation before the old one fully runs out of road? Now contrast that with Italy. If Germany's story is aging efficiency, Italy's is brilliant chaos. Italy is rich in human talent, design, food, fashion, engineering, tourism. But its economy runs on an ultra-fragmented base of very small firms, on average, about 3.6 workers per company. That's tiny compared to the 15 or so you see in other Western economies. And this matters. Small firms struggle to scale, invest in R&D, navigate regulations, or expand globally. They're often undercapitalized, vulnerable to shocks, and overly dependent on local demand. So you get this odd picture. Lots of entrepreneurial activity, but not much in the way of large, globally dominant companies outside a few sectors. It's like having thousands of talented sprinters, but no one building a serious relay team. Then there's the debt problem. Italy is sitting at around 150% debt to GDP. That's a level where interest rates matter a lot. If borrowing costs rise, fiscal space compresses quickly. Think of it like a household making $50,000 a year with $75,000 of credit card debt. You can service it as long as rates stay low and your income doesn't fall. But you're not in a great position to deal with surprises. Add in chronic political instability, frequent changes in government, shifting coalitions, half-implemented reforms, and you get a system that struggles to think beyond the next election cycle. Long-term structural reforms are exactly what Italy needs, and exactly what its politics make very hard to deliver. From an investor lens, Italy is a fascinating mix of opportunity and fragility. Great assets, great people, but high execution risk at the national level. Now let's move to France, the champion of the modern welfare state. Generous social protections, strong unions, powerful public sector, and a long tradition of state involvement in the economy. The French state spends around 57% of GDP. That's significantly higher than most other advanced economies. On one hand, that spending supports social stability, healthcare, education, and infrastructure. On the other, it demands very high taxes to sustain. High earners, entrepreneurs, and mobile professionals face some of the steepest tax burdens in the developed world. Over time, a subset of them simply leaves for London, Geneva, Brussels, Dubai, wherever the after-tax payoff is better. That's your classic brain drain dynamic. At the same time, France is wrestling with labor market rigidities. Hiring is risky, firing is expensive, and regulation is heavy, so companies get cautious. They protect insiders, but they hesitate to bring in outsiders, especially young workers. The result? You get a split labor market, a protected core with strong job security, and a more precarious periphery stuck on temporary contracts or excluded entirely. That tension shows up in protests, strikes, and recurring battles over pension reform and labor law tweaks. France's model delivered decades of stability and a high standard of living. But as growth slows and demographics age, the math gets harder. You can't keep expanding benefits and entitlements indefinitely if your tax base is stagnating and part of your talent is leaving. So when you zoom out and look at Germany, Italy, and France together, a pattern emerges. Different histories, different cultures, but three shared headwinds: aging populations, slower productivity growth, and economic models heavily dependent on past advantages that are now eroding. For Germany, it was cheap energy and world-class manufacturing. For Italy, it was creativity and tourism riding on ever-expanding debt. For France, it was a generous welfare state funded by robust growth and a loyal tax base. Now all three are being tested by the same global forces: rising competition from Asia, technological disruption, deglobalization pressures, and tighter monetary conditions. So, have Europe's great powers given up? I don't think the story is that simple. It's not surrender, it's inertia. The problems are visible. The broad outlines of the solutions are also visible. More flexible labor markets, smarter immigration, targeted industrial policy rather than blanket subsidies, recalibrated welfare systems that are sustainable in an aging, slower growth world. But every one of those reforms creates political pain. There are winners and losers. And in democracies with aging electorates, it's very easy to delay hard choices until later. From an investor standpoint, this is where it gets interesting. We may be moving from a world where Europe, or Xi'an, safe, boring, stable, to a world where Europe is more of a selective, value-driven play. Carefully chosen sectors, specific companies, and occasional mispriced assets, rather than a broad, buy everything European and forget it strategy. I'd love to hear your take on this. Is this just a rough cycle for Europe's big three, or the start of a long, gradual decline in economic influence? And if you're watching from Germany, Italy, or France, what are you seeing on the ground that the data might be missing? Drop it in the comments. If you enjoy this kind of big-picture, data-driven conversation about where economies are really heading, make sure you're subscribed so you don't miss the next breakdown. We're going to keep following how these trends translate into real risks and opportunities for investors. And if you want to support the channel or go deeper with some of the tools and resources I personally use, check the description below. You'll find product links there, and any purchase through those links really helps me keep making content like this for you.